The financial world is still reeling from the collapse of Silicon Valley Bank. While U.S. regulators have stepped in to contain the crisis, shockwaves are still echoing through the economy, with many nursing concerns about the health of the financial system. What exactly happened with Silicon Valley Bank? On a very memorable Friday, Silicon Valley Bank officially failed and was taken over by U.S. regulators. The bank had built a robust business lending money to startups and companies backed by venture capitalists. And like many other banks, it kept most of its customers' deposits in traditionally safe investments like treasury bonds. But as the Federal Reserve began hiking interest rates in hopes of bringing down inflation, those investments lost a lot of their value. At the same time, declining economic conditions prompted many of the bank's customers to withdraw their money. Silicon Valley Bank was forced to sell investments at a huge loss to meet those withdrawal requests, and that triggered a scramble among other depositors who began to worry about the health of the bank and the safety of their money to pull their money out. Now, what is a bank failure? A bank failure is the closing of an insolvent bank by a federal or state regulator. As it holds, the federal government has the power to close national banks, and banking commissioners have the power to close state-chartered banks. This can happen when the banks are unable to meet their obligations to depositors and others. When a bank fails, the Federal Deposit Insurance Corporation covers the insured portion of a depositor's balance, including money and money market accounts. To understand the concept of bank failure better, a bank fails when it can't meet its financial obligations to creditors and depositors. This could occur because the bank has become insolvent or because it no longer has enough liquid assets to fulfill its payment obligations. You may wonder what factors predispose banks to this type of crisis. Well, normally, banks are susceptible to a range of risks. These broadly include credit risk, liquidity risk, and interest rate risk. This is why bank crises can often be traced to a decrease in the value of banks' assets. This can happen due to a collapse in real estate prices, or from an increased number of bankruptcies in the non-financial sector. It can also happen if a government stops paying its obligations, leading to a sharp decline in value of bonds held by banks in their portfolios. Bank problems can also be caused or worsened if a bank faces too many liabilities and does not have enough cash or other assets to satisfy those liabilities. This occurs if many depositors want to withdraw deposits at the same time, or if the bank's borrowers want their money back and the bank does not have enough cash or assets at that period. The bank can become illiquid. While it is important to know the causes of bank failures, it is also necessary to note the difference between illiquidity and insolvency. Illiquidity and insolvency are two different things. For example, a bank can be solvent but illiquid, meaning that it can have enough capital but not enough liquidity on its hands. However, many times insolvency and illiquidity come hand in hand. When there is a major decline in asset values, depositors and other banks' borrowers often start feeling insecure and demand their money back, deepening the bank's troubles. Terrible situation, isn't it? Yet, there is something worse than a mere bank failure. It's called a systemic banking crisis. A systemic banking crisis occurs when many banks in a country are in serious solvency or liquidity problems at the same time. This could either be because all the banks were hit by the same outside shock, or because failure in one bank or a group of banks spreads to other banks in the system. More specifically, a systemic banking crisis is a situation when a country's corporate and financial sectors experience a large number of defaults and financial institutions and corporations face great difficulties repaying contracts on time. As a result, loans increase greatly and almost all of the aggregate banking system capital is exhausted. This situation may be accompanied by depressed asset prices on the heels of run-ups before the crisis, sharp increases in real interest rates, and a slowdown or reversal in capital flows. In some cases, the crisis is triggered by depositor runs on banks, although in most cases, it is a general realization that systemically important financial institutions are in distress, like you would have guessed. Systemic banking crises cause a lot of damages. They lead affected economies into deep recessions and sharp current account reversals. Some crises turned out to be contagious, rapidly spreading to other countries with no apparent vulnerabilities. Among the many causes of banking crises are unsustainable macroeconomic policies, excessive credit booms, large capital inflows, and balance sheet fragilities, combined with policy paralysis due to a variety of political and economic constraints. In many banking crises, currency and maturity mismatches were a common feature. What are the economic consequences of bank failures? Experts agree that the turmoil in the banking world likely won't lead to a major economic disaster. In a recent statement, Gregory Germain, professor of law at Syracuse University's College of Law, said that as long as the Federal Deposit Insurance Corporation is doing their job of assuring that banks are adequately capitalized and properly managed, there is no reason for the current banking situation to have a significant impact on the economy. He also noted, however, that the recent problems in the banking sector has made the economy vulnerable, stating that as the U.S. central bank works to bring down inflation by continuing to raise interest rates, it must be careful not to inflict too much damage on the economy in the process. While Gregory Germain's statement has been penned down, other analysts have raised their probability forecast, stating that the U.S. will enter a recession over the next year from 25% to 35%, reflecting increased uncertainty around the economic effects of small bank stress. Does the banking crisis have any effect on the stock market? Following Silicon Valley Bank's collapse, bank stocks began to go under. Although some have since recovered losses, the stock market was still trending downwards weeks after. Since then, investors have been waiting for a sign that the market will bounce back, but it seems that wouldn't be noticed soon. What will happen to mortgage rates following the bank crisis? Clearly, investors wouldn't be the only ones affected by the banking crisis. Home buyers will also be affected. Falling rates on Treasury bonds, which tend to be more popular as economic conditions worsen, also foreshadow lower rates, seeing that the average rate for a 30-year fixed-rate mortgage recently dropped. What are the possible solutions to bank crises? In a situation where a banking institution faces the threat of insolvency due to a bank run, there are techniques that can be used to prevent negative effects. A bank may slow down a bank run by artificially slowing down the process. During the recession in the United States, banks that feared a bank run would have their employees and their relatives make a long queue in front of the tellers and make small and slow deposits or withdrawals. This would help the bank buy time before the closing time. Banks can also resolve to borrowing money. When the bank's cash reserves cannot handle the number of cash withdrawals, the bank may borrow money from other banks or the central bank. If such banks can be loaned a huge sum of money, they can be prevented from going bankrupt. The central bank, also known as the lender of last resort, can help in this regard. They have a responsibility to safeguard the soundness of banking institutions by loaning out money to struggling banks, preventing a wave of bankruptcies, and the negative effect it can have on the banking system as a whole. Another thing banks can engage in to mitigate bank crisis is deposit insurance. Insurance on customer deposits guarantees participants that, should the bank go under, they will get their money back up to the insured amount. Deposit insurance started in the United States after the Great Depression when the Federal Deposit Insurance Corporation was formed. The body restored public confidence in the banking system, as its mandate was to ensure customers get their money back if a bank becomes insolvent. If a bank collapses, an insurer, such as the Federal Deposit Insurance Corporation, may facilitate a resolution, such as an acquisition by a bank with high capital reserves to help a vulnerable bank, such that customers can then access their deposits under the combined bank. Another option, although less desirable, is for the FDIC to seize the vulnerable bank and conduct an auction of the assets to raise funds to return to depositors. The sale proceeds cover amounts beyond the guarantee by the insurance fund. Any shortfall will be covered by a change in deposit insurance premiums paid by the industry. So, will the recent bank failures trigger a recession? The simple answer is, most likely, no. With the Federal Deposit Insurance Corporation leading the rescue team, it doesn't seem like these problems are big enough to threaten the overall economy.